Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Caleb Frankert, and today I'm joined by my good friend and fellow money muddler, Jason Burnell.
Hey, Caleb, can a podcast about finance be entertaining?
Nope. I mean, not without alcohol.
Woo! That's correct.
Let's mix
We
it
haven't
up,
even
buddy.
started yet. Man,
All right.
We're extra jubilant today for some reason.
Well, it's been a couple of weeks.
Yeah, it has. It has.
Yeah.
The world isn't that jubilant, so we're just going to fake it.
Again, yeah, our joy has to be inside of these four walls now.
That's right.
There's plenty to be happy about,
That's
Jason.
true. You
Today-
made me a drink. I'm super happy.
Yeah, let's talk about that real quick. I'll set up the episode here today. We try on this podcast not to be too headline driven or too worried about what's going on in the world today, because a lot of times, people find out about this podcast and they go back 6 months, they start listening. This could be old news. So
I hope so.
hopefully, yeah, I hope so too. Hopefully this should be good fodder, I guess, for someone down the road for the next time we go through this. But it is kind of timely, and it's about time that we went through this. So we're going to do it. We're going to talk about the markets. We're going to talk about headlines. We're going to talk about pullbacks, corrections, bear markets. Oh, my. And we're also going to enjoy a nifty little cocktail that I just discovered called the Bull and Bear cocktail.
Yeah.
So quite appropriate. We're going to get into why the markets are acting like they are, how to keep a level head when the markets are doing what they're doing. We've titled this episode, Staying Sane When Markets Are Crazy.
Ooh, yeah.
So, Jason, are the markets crazy right now?
Yeah, I mean, it's definitely a volatile time. I mean,
Save it for later.
yes. People are worried, let's put it that way.
You know what I'm not worried about?
What?
Drinking during office hours. So let's talk a little bit about this here cocktail, the Bull and Bear cocktail.
It's delightfully pink.
It's pretty looking.
Yeah.
It looks like it's not the most manly looking drink.
No, I feel like a lady right now.
Well, you look like one, sir.
I did shave my beard.
All right, I'm going to take a sip of this, and then I'll explain what we're drinking.
That doesn't even count as a bourbon cocktail. That's so good.
Oh, man, I can barely taste the bourbon.
Yeah.
Okay.
Oh, yeah, it's there.
It's there.
It came to me afterwards there.
Okay, let me take another sip.
Yeah. It's kind of summery. I like it.
It's very summery. It's very summery.
Yeah, deep-seated hope inside of us.
Yeah. This is a beach cocktail in my opinion.
Yeah, that's good.
Okay, so what we're drinking here, the Bull and Bear cocktail. I don't have any origins. I don't have any controversial history like we do sometimes.
We developed it here.
I did not develop it.
Oh, okay.
Although, the funny thing is, what we got here, it is a bourbon cocktail, although it really doesn't taste like one. If you're a listener and you've avoided bourbon cocktails, maybe you don't like the firewater, this might be one to... It reminds me of the Scofflaw a little bit, in that it was a pretty sweet and citrusy kind of drink that used a rye in it. Yeah, if you're a bourbon guy... This is probably not the best cocktail.
You wouldn't have one of these every night, that's for sure.
No, this is vacation drink, in my opinion, which reminds me, I'm going on vacation next week.
Woo!
We are going to Disney World.
I'm sorry, take the real bourbon.
I'm going to need a vacation when I get back, Jason. What we're drinking here does contain bourbon, 1.5 ounces bourbon whiskey. I took the liberty, Jason, and I put 2 ounces in these instead of 1.5.
I'm disappointed.
And we used Evan Williams in this one, the bottled in bond version. So it's a little bit...
It's a good mixer, though.
Yeah, it's a great mixer. It's a little more potent, but it's still, I'm not tasting it because we've also got 3/4 of an ounce of lime juice in there. I'm tasting a lot of that. Mm-hmm. We have a tablespoon of grenadine. That's what gives it this pretty pink color.
Definitely.
And then we've got 3/4 of an ounce of orange liqueur. Now, this could be a Curacao. It could be a triple sec.
Grand Marnier.
Grand Marnier. Yeah, it could be a lot of different orange liqueurs. I just went with cheap old triple sec because that was what was in the cabinet. I don't taste a ton of it in here.
I don't either.
But I don't generally.
It's the lime. I mean, that's what I'm tasting.
Yeah, that's why I think this tastes like a vacation drink, like a beach drink.
That's okay. Woo! Vacation when the market sucks.
Yeah.
Wait, we shouldn't say that.
Well, we'll get into the market here in just a second. Yeah. What are your impressions of this one, Jason?
I think it's pretty light considering that it's got 2 ounces of bourbon in this thing. Yeah, lots of orange flavors. I love that. I'm on the vacation drink kind of mentality here.
Well, you just got back from Florida.
I did.
So
I did.
Maybe
I didn't
a little
have any of
sunshine.
these.
Maybe a little sunshine carrying over into your Monday.
Yep.
So, and you know what? I didn't talk about the garnishes here. I garnish with an orange peel and a Luxardo cherry, which was recommended. We always recommend the Luxardo cherry, by the way. Yeah, this is very limey. It's very limey. I like it.
It kind of has a margarita kind of feel to it.
Yeah,
I mean, it just does. I guess, two of the ingredients are very similar.
Right,
so.
lime and triple sec. I'm seeing the grenadine, but I'm not totally tasting it.
I'm not either.
The bourbon is really hidden, which that's
dangerous.
Well, it's dangerous, but it's also, I'm going to, I guess we have never rated cocktails before, and I'm not going to start now, but if I did, it would be demerits for hiding the bourbon. So I wouldn't use a good bourbon in this. Well, no, I wouldn't use a good bourbon in this.
So. No.
Normally, I feel like if you use a good bourbon in a cocktail, a lot of people think that if you use a good bourbon in a cocktail, you're wasting it. I found it's the opposite. When you use great bourbon in a cocktail, it shines. I think it would be buried in this one.
Yeah, a more of a bourbon heavy cocktail. But again, there's still 2 ounces here.
Somewhere.
I mean, I like my drinks really cold. So anytime you use the shaker, strain this thing into a glass, I like that part. So that's instantly like summer vibe for me. So
yep.
Again, wishful thinking.
Total beach vibes. Although it's sunny out right now, but it's March. Hey, anything can happen. So... something to fight off the March sadness here in the markets recently. So again, we don't want to be too topical. We don't want to be too headline driven. But Jason, this is timely. We're going to talk about the normal throes of market corrections and pullbacks and things of the sort. We're going to talk about declines in the market today.
Great.
What do you think? Are you excited?
I know.
Well,
I've been in this business a long time, and it's always hard. I'd be lying to you if I said it wasn't. Even all the knowledge we have and the things we hang our hats on, like nobody emotionally likes going through this.
Yeah. Let's just dive right into some of the emotion behind it. Like you said, it's always hard. And look, this is a great career, but whenever the markets just go up, everybody's happy, but people start to question, well, why do I need a financial advisor? And a lot of times I'll say, well, wait till we pull back and then you'll understand why we need a financial advisor. But it's hard when things pull back too.
It is. Yeah. Even for us. And I think we know, part of that is it comes along with our clients just feeling like, man, is this going to stop?
Right.
And, we're inundated with financial pornography all over the, TV, and our neighbor, said they got out, or, they bought, I don't know, titanium and put it in their basement.
Well, yeah, the market timers come out of the woodwork, and we've talked ad nauseum about timing the markets, and we never claim to be market timers. The truth of the matter is, if you could time the market effectively, if someone could, then someone would. And then someone would duplicate the process and everybody would do it. It's just not that easy. So
they don't ring a bell when it's time to sell.
Yeah, Jason, what are you quoting?
That was Bill Henry, and this is a book called The Maxims of Wall Street. And I that one has been in my head.
Yeah, I've used that one a lot, not knowing who Bill Henry is. It's true. They don't ring a bell when you're at the bottom. So to build on that, let's talk about getting to the bottom. We've had a good run in the markets over the last few years. The perpetual doomsdayers, the perma bears, right? We call them. They've been calling for a market pullback forever because that's what they do. It's bound to happen. We understand that it's going to happen from time to time. So let's talk about the different stages. So when we're talking about declining markets,
these aren't emotional stages, by the way.
These are not emotional stages. That's for a different podcast.
That's correct.
And that is our job, to be guidance counselors at some point. We do a lot of that during times like now. Typically what we see is, pullbacks, corrections, and bear markets. And I feel like a lot of these get all muddled up, if you will.
They don't ever they will flash the bear market one on TV, but they rarely flash the other two. They're not as doomsday and don't put you on the doorstep of hell quite like like a bear market does.
They don't talk about the bull market a lot either as we're sipping on these bull and bear cocktails. We hear a lot about the bears, but we spend way more time in bull markets, historically speaking. So, yeah, I also find bear markets, I think a lot of people have the correct definition of a bear market. That's a 20% drop from recent market highs. Now, bear markets, sometimes you'll hear it even in a bull market when things are going well, that this stock is in a bear market or this sector is in a bear market. We're going to just talk about broad market indexes, and we're going to pretty much stick with the S&P 500. We might dig into the Dow a little bit when we look at some of our numbers here today.
Sure.
But those are kind of the big barometers that people look at as far as stock markets are concerned. Bear markets, 20%. I think a lot of people know what that is. They get that correct when they say we're in a bear market or we could be looking at bear market conditions. The other one we hear about from time to time is correction, okay? I hear this one overused and misused all the time. When the market goes down 2-3% in a day, it's not a correction, but you hear the talking heads say, oh, the market corrected 2 or 3% today. That's not the case. That's not even pullback territory by definition, but a correction technically would be 10 to 20% negative from recent highs.
Right.
Then you've got your pullback, right? Sounds a lot less severe because it is. Pullback is generally 5 to 10%, okay? So these are things that happen from time to time. And Jason, as of today, when the podcast comes out, this is going to be different when this episode
It'll
is
probably be
released.
all over.
Yeah.
I hope so. Wishful thinking.
That would be great, actually. But yeah, so if you're listening to this episode, we'll tell you how you should have got through things a couple of weeks ago.
Right, exactly.
As of now, I looked at the numbers today. The S&P 500, which is what everybody looks at, is off 13% from recent highs, which were in early January. So we got into that technical correction towards the end of February, and that's where we've been living for a little while.
Right.
It feels like we've been there for a long time. The Dow is down about 11. Same thing. We crossed into correction territory, right around there. But I'm going to start from the top and talk about pullbacks at 5 to 10%. Obviously, this is what happens first. There are certain circuit breakers and triggers in the market that will prevent us from going straight to a correction, right?
Right.
How often do pullbacks happen? There's a lot of information out there, some of it conflicting, even looking at the same indexes, but we average these more than once a year.
Right.
And I think that this is something that most investors are pretty used to when they get their statements and they go, oh, I was up last month, but I'm down this month. Well, okay, we'll be up next month, right?
Exactly.
So pullbacks, pretty normal. We average those once a year.
And I mean, depending on what we're buying, if you're looking at an index, though, a 5 to 10% pullback may not be as obvious.
Sure.
There could be components of the S&P 500 or the Dow that have already hit the pullback number.
Sure.
And, it could be simple rotation in or out of a particular sector, or, earnings came out or earnings are going to come out. So, yeah, I mean, the pullbacks, common.
Cool. Yeah, very common. I think we expect these things. They happen more than once a year, and they usually, on average, take about a month to recover and get back, okay? So is something interesting that you said is sometimes we look at the indexes and we see that it's pulled back while different components of that index may be in correction territory.
Right.
Or bear market territory. So what I find interesting about this recent correction, which we've entered into, is that in the S&P 500, as of the time that I'm looking at these numbers, over 50% of the stocks that comprise the S&P 500 index were already in bear market territory.
Right.
20% off of their highs. So you look at the major indices and you could say, oh, this isn't very good. We're down 13%. I'm starting to worry a little bit. What about if we get into bear territory? For over half of the market, they're already in bear territory, which says that the other half of that is holding things up quite a bit, right? So is that a cause to be concerned that things are going lower, or is that a reason to think, hey, maybe we've seen more of the losing, I guess, already that we is not reflected in the indexes, right?
Again, like popular thinking is going to tell you that it's just begun. Only half of the 500 are there, and the rest are going to go. And I think that's again, it's something you have to like emotionally combat. Mm-hmm. And even if they do go to correction or full correction or bear market territory, it's happened before.
Yes. And it will happen again.
It will happen again.
Yeah. Something that I've said a lot in reviews with clients here recently, maybe I shared this on a recent podcast, but we are off of our all-time highs. If we don't recover and set new highs, this will be the first time ever Think about that, though.
Right.
The market has pulled back, but it has always returned to set new record highs.
Yeah, I mean, and there's some real value in kind of the adjustment, the rearrangement, the rotation that comes from selling. There's no doubt. I mean, and you can watch or read news, and it tells you about companies that have just like hit, unbelievable marks that really were unbelievable. So it's good. It's actually a cleansing from a certain perspective. Again, nobody likes to see it, but it does give a clearer perspective on the valuation of those companies in the market. So I think there's some health to it. It's kind of like that, that controlled burn that you do in a forest. Yeah. It's healthy for the forest to burn some and, promote new growth and kind of set a new...
Get rid of some of the riffraff, some of the froth, right?
Well, and there's no doubt that in every one of these scenarios, there's a super healthy dose of speculation, which we can talk about that in a whole different episode.
Yeah. So we are in a correction, Jason. We talked about pullbacks and how they happen usually more than once a year, but it doesn't take a whole lot of time to recover. So people get through pullbacks. Usually we get to correction before we realize there was a pullback.
Right.
So we've been in a correction here for not quite a month, but it feels a lot longer than that. These happen on average about every 2 years in the S&P 500. So we're kind of right on pace, aren't we? The last correction would have been March of 2020, which was more than a correction.
Right.
That was technically a bear market.
Yeah.
The shortest one on record. Corrections tend to last on average. I thought this was interesting. They tend to last about 4 months before we recover and set new highs.
Right.
So at this stage in the game, I think people are feeling the pain a little bit. They've had a couple of rough statements, right?
Correct.
They're going to get quarterly performance reports that show negative, and it's been a while since we've seen numbers like that. So it's starting to feel the pain a little bit, but we could say that on average, we've got another 3 months to go before we come out of that and set new highs, right?
Correct. Yep. I mean, and corrections are normal. I mean, the data even gets more fascinating around a 10% correction. We're using a range of 10 to 20, average every 2 years. It's a pretty broad range. And I would say generally in the last, since the last real deep bear market in 2008-9, we were kind of spoiled,
Absolutely.
Not a lot of corrections on average. So
no, in fact, we were guiding clients at that time, right?
Sure,
That corrections are normal and we haven't seen them, and bear markets are normal and we haven't seen them. Will we at some point? Yeah. And the thing that I always say is averages are averages for a reason.
Right.
We usually revert to the mean, right? So if we go, it was 11 years. Right. It was 11 years without a bear market. So what if we had a couple more and they happen more frequently here over the next 10 or 11 years? Would that shock anybody? I don't think it should, because that gets us back to the average. Now, that doesn't mean it's fun.
Yeah.
That doesn't mean it's fun. So bear markets, let's talk about that. Neither of us are forecasting a bear market. Could we go there? Yeah, sure, absolutely. I don't know. We talked earlier, we were on a conference call with mutual fund money manager, and they were kind of doomsday-ish. And it reminded me of a movie that I watched recently. Yes, I'm late to the game. Moneyball.
Yeah, oh yeah.
Where Brad Pitt's character is sitting there listening to all of his scouts trying to figure out how to replace talent. And he's just shaking his head going, blah, 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 blah. You don't know anything. This year is not like last year.
Right.
No 2 years are alike. You guys are just basically going based off of what you think you know, and you don't know anything. Blah, blah, blah.
Right.
That's what I felt when we were hearing all this talk about how bad it's going to get.
And it was like depressing. Like,
yeah,
I find it kind of unfortunate that you're hearing these professional money managers talk about negative GDP in the US. And, after, the US has come off of a significant GDP year, or very, very strong.
That's gross domestic product, if you are listening and new to some of these acronyms.
Yeah, so that's the measure of our output. And, the U.S. output compared to the world, it's 27% of the world's output. Like, we have a really good thing going here. So bear markets happen. They are no fun. They're all kind of unique. Mm-hmm. But, the reality is we have to shift our thinking a bit and just realize that, regardless of what the TV's telling us, this is actually relatively normal.
And, what I try to put in perspective, especially with clients, is, I look at these averages, I look at these numbers. Again, I could say blah, 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 you know nothing to myself as well, because I don't know what's going to happen. You don't know what's going to happen. Again, if we did, we'd probably be sipping on these bull and bear cocktails on the beach somewhere. But, bear markets roughly every 5 years, maybe a little under every 5 years on average. These ones sting a little bit more. They last a little bit longer, on average about 12 to 15 months. But it's like I tell everybody, markets usually go up.
Right.
Markets usually go up. And you could really look at the numbers and say 3 out of every 4 years we're probably going to be positive. So it makes sense that a bear market every 4.5 to 5 years that takes 12 to 15 months to get out of, that would be our negative year in there.
Sure.
We take our lumps. We don't always make money. The markets don't average 8% over 100 years because they go up 8% year over year over year over year. If it did, that'd be pretty darn easy, and I think everyone would do it.
Right. That's why we get clients in here that are like super hesitant. I mean, It doesn't do that, and they know it.
Yeah, I mean, you might be up 30% one year and down 10% the next year.
Right.
And we know that clients don't celebrate the up 30 years as much as they fret about down 10%.
Right. That's that emotional component of the investing that, it's hard to see, the losses, even though the gains might they definitely will outweigh over a period of time, especially 5 years.
Yeah, this is where it takes really sticking to the plan, maybe putting the statement away for a couple of months, maybe turning off the radio or turning off the news if it's making you squeamish. But
right.
There's some encouragement out there, Jason. So I read some of these statistics. Some of this is from Charles Schwab's website, and I'm gonna read a couple that I highlighted here about corrections and pullbacks and bear markets and the lasting effects and all that good stuff. Since 1974, the S&P 500 has gone up, on average, more than 8% 1 month after a market correction bottom. So the bottom of the correction we're talking about, okay? And up more than 24% a year after.
That's an amazing stat.
If you
24%, man.
So here's the problem. Like you said, they don't ring a bell when you hit the bottom, right?
No.
They don't ring the bell when you get to the bottom. So who knows how much further it's going to go. And I always say, if we hit that 10% number and we keep going, we probably got a little bit more way to go. A lot of times we see that 10% bounce.
Yeah, you often hear that referred to as resistance in the market. So it's almost like a trampoline effect. If you go through the bottom of the trampoline.
Right. you got some more room to fall to get to the ground.
Right.
So they don't ring a bell, right? But let's say today was the bottom. I don't know that that's going to be. If you could tell your clients, look, it's okay, because on average, we're going to be up 24% a year from now. I think everybody'd be pretty happy with that. Right?
Exactly.
So these corrections, they're not uncommon. They're built in, right? We talk about this. It's going to happen. This isn't the first time, and it will not be the last time.
But there are some words of hope here.
There are words of hope. Let's look at just the last 20 years. So going back to 2002 to 2021, a 10% correction happened about half of the time, or half. So 10 out of the 20 years, okay, 50% of the time. Average pullback, they say pullback in here, but technically correction.
Right.
With an average correction of 15%. Well, we're getting pretty close to that in the S&P at this point.
Right,
and some days we've been real close to that. Okay, so in 2 of the additional years that we didn't quite hit that correction territory, just short,
right.
Maybe I can remember a 9.8 one time. And I said, good enough, we'll call it a correction. But despite these corrections, the stock market tends to go up in that same year. Positive returns over the last 20 years, in all but 3 years, and an average gain of approximately 7% in those years where we've had technical 10% correction.
So in all of that, you're basically saying that corrections, like we said, equal to new growth.
So if this were an average year, and we are hitting, we're in that average correction. Let's say we hit that 15% average correction.
Mm-hmm.
On average, we should still be positive single digits this year. I think if we told most of our clients today, it's okay. On average, we'll still be positive this year, about 7%.
Most of them would be thrilled with that at this point.
Averages are averages for a reason. Let's look at a longer term.
Right.
Let's look at the bigger picture. And we touched on this earlier. The last bull market, not including this current one, okay, because we're still in a bull market. The last one brought gains of more than 400% over 11 years.
Right.
400%. So that was that 08, 09.
Right.
That was pretty bad. We had a long way to go. But 400% over those 11 years. This current bull market that we're in, going back to March of 2020, that shortest bear market that we've ever seen, we're up over more than 100% in less than 2 years' time. Okay. So a 1 month bear market, if we would see another bear market and we might feel the pain a little bit more than a month, we are overdue probably.
And we survived a global pandemic.
Yeah.
Like, I mean, that is like when you really back out a little bit and go, the economy was shut down.
Absolutely.
And I mean, you talk about the insult that the economy took at that point. Not only did we recover from that, we found new ground. The economy, to some degree, is still fully functional and not struggling. But there are reasons to be concerned. But at the end of the day, we did pretty well out of a pretty horrible situation.
I always say that these are averages for a reason. They happen. We don't know what the catalysts are going to be. So I know we look at today, and I hate to do this to our podcast and make this headline driven. Today, we're worried about Russia and Ukraine and energy prices.
Inflation.
But inflation is something that, and we talked about this on a podcast a couple of months ago, it's inevitable.
Right.
It's going to be high. It's going to be here for a while. You don't print the money that we printed and not get inflation.
And that's the key right there, is we printed such a significant pile of money. I mean, everybody was getting helicopter money last year. So, in the last 2 years, really. And you can argue the fact if it worked or it didn't work. The reality is those dollars got to work their way through the economy, and things are still stabilizing. I mean, people are going back to work, and supply chains are catching up. So
we're talking about inflation where it's at year over year, but demand hasn't shut down.
No,
right?
Not really. I mean, at least we haven't seen signs of that yet.
And we'll know in 6 months.
Well, that's really
how it always happens.
I think we've got a healthy component of clients asking, "Are we in a recession?" And
we'll know in 6 months.
We will know in 6 months. But I mean, I would have to argue that, a lot of what we're doing right now is just equalizing off the effects of a global pandemic.
Right.
And we have a headwind like Ukraine and Russia, but it's
that's driving the headlines.
It is, right?
And that's,
for sure.
I think, giving an opportunity for some of these, I think, locking in some of the gains over the last bull market, right?
Sure.
Taking some money off the table. The headline's the excuse to make some money, to sell a little bit and look for an entry point to get back in. But bottom line, corrections aren't the end of the world, and that's what we're dealing with. Remember, the last bear market was the COVID crash, I call it. And it turned out that wasn't the end of the world. Are we still dealing with the effects of COVID? Yeah. But
I mean,
the markets
2 years later,
right? But that's the thing. The markets are forward-looking, right?
Correct. Yep.
So we felt the pain in March of 2020 when we realized it wasn't going to be the end of the world. We still had some things to work through.
Sure.
Markets went back up. So we're looking at, of course, at valuations and things like that now. Where are we going to be? The market is forward-looking. Well, we don't know. But here's some other comfort, Jason.
Ooh,
this is a correction. 80% of corrections since 1974 have not led to a bear market.
That's amazing.
So there's some comfort there. Have there been reasons to be worried since 1974? You better believe it.
A whole bunch.
So going back to, and this is the last fun fact I think I'll share, maybe. There have been 27 corrections in the S&P 500 since World War II, with an average decline in the index of about 13.7. So we're right there. Could you say that we're on average? They're short term. Again, we talked about 4 months to get back to former highs. Okay, so we might have another quarter worth of trouble here. Since 74, 5 market corrections have turned into bear markets. Could we go there? Sure
could.
I think we talked about the legitimacy of the last bear market. Did it really happen? I don't know. Maybe it's just an extended bull. Yes, we will go back there. But if we can stick it out for 12 to 15 months, we'll set new highs on average.
And most of our clients we're dealing with, their outlook is much longer than 12 to 15 months. I mean,
quite frankly, we wouldn't be invested if it was shorter than that.
That's correct.
Right?
Yeah, we would tell them that you just can't.
It would never be appropriate to have our money invested in the markets if our time horizon were 12 to 15 months. So rest easy, even if and I'm helping, wouldn't you know, a bunch of people making retirement decisions today.
Right.
And they're concerned.
Tons.
Man, I turn in my retirement papers and the market goes down. It's okay. We're going to get through this. Let's talk about some tips, some things that we can do to keep our heads, to stay sane when the markets are crazy. The first one, Jason, I'm going to say, and I'll list a couple of them off and you comment.
Sounds good.
So the first one is, if you have to, avoid the news, avoid the headlines, avoid the radio. the talking heads, and by all means, avoid talking stocks with your friends, especially the day trader friends.
Goodness gracious. Yeah, this is a huge one. I mean, just turn the TV off. Talk to your spouse. Talk to your kids. Pick up the phone. Stay off of Facebook. It's just a recipe for emotional disaster.
If you got to look at the headlines, then I think that you got to say, okay, how does this headline affect my long-term goals? And if the answer is doesn't, then stick with the plan. Second thing I'll talk about as a tip, this could be a really good opportunity to consider rebalancing your portfolio or to look at tax loss harvesting, tax strategy. What do you think about that?
Yeah, I mean, that is one that we're definitely looking at. If you think about, big gains that you have, maybe offset that with a loss so you don't have as much cap gains on your taxes. Also think about Roth conversions.
Yeah,
I mean,
it's a big one.
You've got a lot of shares that you still own the same number of shares that you did in January.
We've talked a lot about Roth conversions on the podcast.
Right.
Why not take the dip as an opportunity to pay less taxes?
It's a great opportunity. You own the same number of shares. Just move them over to your Roth, and man, you talk about like Roth conversion on steroids. Once this thing comes back, it's a great place to be.
If we're down 15%, then look at it as an opportunity to maybe pay 10 or 15% less in taxes.
That's correct.
So you got to look at the bright side. And the last thing I'll say is look at this for an opportunity to dollar cost average. We did an episode on dollar cost averaging. If you've got money on the sidelines because the markets have been too frothy over the last couple of years, and you've been trying to pinpoint that entry point to get back in, well, stop trying to pinpoint.
That's right.
But when we're in correction territory, I just say, put your brain on autopilot and start dollar cost averaging. Set aside an amount that monthly you're going to invest into your funds, and then let it do its thing.
Yeah, consider increasing your 401k. Put a little bit more in your Roth. Now is the opportunity. Turns out you don't get them that often.
No.
So
not as often as we talk about,
not
right?
when it's quite this obvious. So just take the chance. If you're long-term minded, go ahead, throw some funds at it, and see what happens. I mean, it's going to be positive, especially over a 5-year period of time.
10 years
or longer.
And beyond.
Yeah.
Absolutely.
Exactly. Right.
All right. Well, this was a fun one. Thanks for having a drink with us this week, folks. It's time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance podcast, be sure to email us at speakeasy@oldfashionedfinance.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with all of the latest action by following us on Facebook and Instagram. Old Fashioned Finance is brought to you by Blue Jay Financial Group. That's bluejayfg.com, and produced by Podastery Studios. We've been your hosts, Caleb and Jason. Woo! Cheers.
Blue Jay Financial Group, LLC, Blue Jay, is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction unless otherwise permitted by statute. Follow-up or individualized responses to consumers in a particular state by Blue Jay in the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant to an applicable state exemption. All verbal and written content on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.